makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The bond sell-off takes a breather after a bruising few days, giving some relief to markets. The focus is on tomorrow's jobs report. Oil treads water after the largest daily drop in a year amid fears of a slump in U.S. demand. Plus, coming up on Bloomberg UK, Rishi Sunak's reset. The Prime Minister rips up the country's flagship rail project, taking aim at the record of his predecessors. Now, good morning, everyone. We have definitely a packed show. Let's take a look at what's going on with European markets map. Now, it has been a wild ride when you look at markets over the last 5 days. European shares at the moment creeping higher a little bit, practically unchanged for a lot of the main benchmarks. We did have 3 straight days of losses. We had some softer U.S. economic data yesterday, which really sparked a late bounce on Wall Street and seemed to soothe fears of a Federal Reserve interest rate hike next month. Now, the relief yesterday came after there was data showing that U.S. companies added the fewest jobs last month since early 2021. But if you look at what the U.S. 10-year yield has been doing over the last 5 days, look, markets, I think, are still struggling to gain traction after this bruising cross-asset sell-off that wiped trillions off global equities and bonds amid this uncertainty over how much higher U.S. interest rates could go from the current 22-year highs. And that's the picture of the U.S. 10-year yield over the last 5 days. A couple of other things we need to watch out. I think Alstom, one of the ones that are moving the most, I have to say bonds due in 2029 are dropping the most on record. Now, for more on the markets, let's get straight to Bloomberg's Valerie Teitel, who joins us with the latest. Valerie, what you got?
It's a fast-moving market this morning in the Treasury market. We did walk in this morning seeing a bond rally across the screens, but now it's slightly more mixed, and my eye goes straight to the weakness that we're still seeing in the long end. Those long end yields are rising 2 basis points. But let's take a look about how the bond rally was sustained yesterday in my next graphic. We're quite off the highs when it comes to the 10-year yield, nearly 15 basis points off the highs that we reached at some point yesterday. But that goes to show that this has been a historic drawdown in long-term treasuries. If we flip on and look at my BTV, you can see that the long-term treasury index that Bloomberg holds is down nearly 50% from the peak. And this is important, Francine, because we can compare it to what happened during the dot-com bust, for example. During the dot-com bust, equities were down 49% after that. And we're seeing quite an historic meltdown when it comes to the bond market as well.
Valerie, thank you so much. Valerie Teitel there with the very latest on some of this meltdown. Now, joining us is Johanna Kyrklund, Chief Investment Officer and Global Head of Multi-Asset Investments at Schroders. Johanna, what a week to come in. I mean, I feel like everything and anything has happened in between. The underlying, I guess, assessment so far is that we're going to see a lot more volatility, or you think things will come down from now?
No, I think that we still have some challenges. I think that basically the sort of the sell-off at the long end of the curve is really driven by the fact that at the moment nobody's expecting a recession in the States. Yeah. To justify the pricing and the inversion of the yield curve, that's what you need to see. So while we're seeing good news on inflation, which is supportive of the front end, I think ultimately the Fed is plateauing here. There's still, as I said, the pricing of the long end is still problematic, so probably a bit more work to do. But, you know, all in all, I think eventually things will settle down.
But if you look at the week that was, were you surprised as how quickly fear can grip the markets? I know there's been perils to .com. I know there's been perils to some of the other bouts of volatility that we've seen. And it's unclear the catalyst of what that was and what that means for the next 6 months.
It reminds me, I mean, it does remind me of that period of time back then when we had the bursting of the dot-com bubble. Ultimately, there were some fundamental assumptions that had to be revisited. And the same has happened with the bond market. Big picture, we think we are in an environment where there's been a deterioration in the growth and inflation trade-off. You know, ultimately, we think that new ranges are required for bonds. And the last 2 years have really been about bond investors getting used to that fact and accepting that we're not going back to what was true the last 10 years. So whenever these fundamental assumptions get challenged, you know, it takes a while for markets to adjust. And that's why, obviously, we're seeing this bear market in bonds. The exact timing of it then varies. But yes, I mean, I think it's fairly typical of, as I said, ultimately a fundamental reevaluation of what the right level of long-term rates is and ultimately what that means for bond markets in general.
So, Jen, how do you build a portfolio then? What are you constructive on at the moment?
Well, actually, I mean, I think there's still a role for bonds, but as a source of yield. I think that, you know, I was hearing earlier on your show that there's talk of the fact that for bonds to rally, you need equities to sell off. that's assuming that negative correlation that, again, we saw in the last decade works. Again, I
Big
think
assumption.
That's a massive assumption right there. I don't think we could buy bonds for their correlation benefits anymore, but the good news is they are providing yield, and that income in itself, in terms of its payoff, is diversifying. So, again, when 60-40 was invented, the classic balance fund, by the way, the correlation between bonds and equities back then was positive. So we're going back to the old reason for owning bonds, which is for income.
Is this, across, I know there's different maturities, but is it, how much different is it if you own gilts compared to treasuries?
Ultimately, it's about the maths of the curve. So, the kind of areas we like the front end of the US curve, but not the long end, because, again, you still have to pay to own it. It's negative carry. Yeah. We like European investment grade debt because the spread there helps to stabilise, buys you time. I think gilts is still a challenge because ultimately, again, that deterioration between the growth and inflation trade-off is particularly bad in the UK.
What does that mean, Johanna, for when do you actually think that we'll start cutting rates, that the Fed will start doing that? And that, how much does that change the regime?
Well, I think, again, within the bigger shift in markets, you'll still get rate cycles. Eventually, the Fed will cut rates. But for now, based on our expectations that we're not getting a recession, and in particular the fact that government spending, the taps are still staying firmly on, particularly going into an election year, we agree with what's priced into the market, that the Fed is likely to stay on hold for quite a while. So, again, investors have tried to price this Fed pivot so many times, started in the summer 2021, tried it again in 2022. The Fed has actually been very consistent in saying they're no rush to cut rates, so maybe we should just listen to what they're saying.
Johanna, overall, when you look at some of the equity earnings that we're expecting, how much will that dictate where you see value? I know there's been a sell-off in tech and certain parts of the markets right now.
Well, ultimately, if inflation continues, ultimately the statistics are supporting this idea that the Fed is probably done. That should take some relief off bonds, ultimately can support tech valuations. I think the style argument is quite difficult in this environment. There's many cross-currents. I think the thing to focus on within equities is more the different regional trends. We're seeing unprecedented divergence, actually, across the regions this year. We hadn't seen that for a long time. In a world of zero rates, everything moved together, while now we're seeing, obviously, Japan doing very well, Europe struggling. Those are where we're seeing the opportunities on region rather than sector or style.
Johanna, thank you so much. Johanna Kyrklund there from Schroders stays with us, and we'll talk a lot more about some of the regions they're interested in. Now, Alstom plunging after the train maker slashed its free cash flow forecast following a delay on a contract inherited from the troubled Bombardier acquisition and a steep rise in inventories. Now, we'll have plenty more, of course, on Alstom. Also, Amazon and Microsoft's cloud services face an investigation by the UK antitrust watchdog over concerns that the US firms may be abusing their market powers. Now, communication regulator Ofcom has officially asked the Competition and Markets Authority to conduct a formal probe. That's after its own study found evidence that Amazon and Microsoft made it hard for customers to use multiple services or switch suppliers. Coming up, we have a lot more on the markets. We continue the market conversation, including the easing of the bond sell-off after a bruising 3 days. This is Bloomberg. Now, oil clawing back a little ground today after signs of weaker demand, sparking the steepest one-day drop in WTI in more than a year. Now, for more on all of this, let's get straight to Bloomberg's Anthony De Paula in Dubai. Anthony, good morning. So what does that say actually about the market's reaction to U.S. data versus OPEC's Plus decision to keep output cuts in place?
Good morning, Francine. Yeah, what we saw yesterday was really the market reacting to that new data coming out of the U.S. What we saw was some really weakening signs of gasoline demand there, and an inching up in some of the crude storage numbers for Cushing, which is one of the most widely watched commercial storage areas. That's really what influences the market. As gasoline demand looks a little bit weaker there, that potentially impacts how much the refineries are wanting to buy. And so that's a bad sign kind of coming out of this period that was the summer driving season in the United States. So we're supposed to be coming into a slower season anyway, but that's kind of a bad sign. And that's been contradicted with OPEC's news. That's on the supply side. They're keeping in place their production cuts and their quotas at the moment. The market was expecting that. They'd already said that those cuts would stay in place until the end of the year, but potentially we could have gotten some kind of revision or some kind of language change. We didn't get that, so the market really reacted to that kind of negative viewpoint out of the U.S., and that's why we saw that drop yesterday, Francine.
So, Anthony, what does that mean for where you see the price of oil going? I know when you speak to top investors, they always say, look, you need to predict between 70 and 150, which is of no use to anyone. But is $100 now out of the equation?
Yeah, $100 was the talk of the town just a week ago when we were, around the 95 area, and now we've come down almost $10 within a week. That was really based on a lot of supply constraints there. And last week we saw some really tight numbers on the Cushing oil supply in the United States. So we see how much a week can change things. But we are looking at, as I said, those OPEC cuts continuing through the rest of the year. OPEC is really targeting the commercial inventories, trying to take oil off the market by undersupplying the market. So as long as the demand does continue, we should see some continuing tightening throughout the rest of the year. Now, of course, we were at a big oil conference in Abu Dhabi this week, talking with a lot of producers and consumers. We saw comments from the Indian oil minister saying that they wanted to see oil around $80 as a fair price. The NECO was saying that he saw an average of about 82, 83. Well, it just happens that 82 is the average that we've got so far. So we'll see, whether we do get those peaks up to 100 as demand does increase and the Saudis and the Russians keep that oil supply restricted towards the end of the year, or if we average out at a lower level, Francine.
Anthony, thank you so much. Anthony DiPaolo there with the very latest on oil. Our big number, it's a good big number, Anthony. So I know you know it by heart. It's tattooed to your brain, but everyone else should also have a look. This is the U.S. seasonal gasoline demand slumping to the lowest level since 1998. That's 25 years. Anthony will have plenty more on OPEC and oil throughout the day. Now, still with us, Johanna Kyrklund, Chief Investment Officer and Global Head of Multi-Asset Investments at Schroders. I mean, it's an absolute nightmare, Johanna, trying to figure out what oil is, right?
Yes.
Because it's so unpredictable in many ways. What do you use for your base forecast that also filters through inflation?
Well, generally, again, I mean, oil and commodities more broadly, going back to our conversation just now, quite an interesting allocation in a way that they weren't in the last decade. So generally, we've been dipping in and out over the last couple of years. Quite a good geopolitical hedge, good hedge against inflation. Our assumption is, yes, you're seeing those higher oil prices started to bite in terms of gasoline demand, so we're seeing that fall. But ultimately, this sort of chronic undersupply is something we think continues for a while. So, generally, we're still fairly positive on commodities. We see them as a diversifying investment, and oil is quite an important part of that. And that sort of higher rates and oil, I think, ultimately does bite into U.S. consumer demand. So we do think things will slow as a consequence.
And Johanna, tactically, how much do you look at sectors and earnings specific, or how much is it regionally? I know a lot of the companies, for example, the FTSE companies are very international. A lot of them are very commodity rich. But what do you do with Japan equities right now, for example?
Well, again, I mean, we're seeing these diverging rate cycles, which we haven't seen in a long time. We like Japan because ultimately the Bank of Japan is keeping things very loose compared to the rest of the world, so it's still a market that we like owning. And on the other hand, I think in Europe we're seeing that slowdown coming much more meaningfully, so it's an area that generally we've been avoiding. The UK is an interesting market. You say, from a sectoral perspective, it was out of favour for so long. Actually, these days, the sectoral composition is more interesting in an environment of, potentially higher commodity prices. It has a defensive bent to it. A weaker sterling is helpful for FTSE earnings. So, I think it's fashionable to be very negative on the UK. I'd say there are some positive things to say about the FTSE right now.
Actually, we have a podcast, and we spoke to the boss of the LSE, and she was extremely optimistic. And she was saying, we've just been too pessimistic.
Yes.
And I don't know whether at some point you have to hit bottom, and so you go back up, or there's just been a perception that the UK has been oversold when, in fact, it had pretty strong fundamentals.
The fundamentals have always been okay. As I said, it was so out of favour, particularly when we had a very tech-driven market. We lack tech in the UK index. But as I said, the sectoral composition is becoming less of a challenge for it now.
Johanna, when you look at Europe, so it's been, in terms of valuations, they look pretty cheap to a lot of other parts of the world. Is there anything that you like in Europe particularly?
No, I think the challenge with Europe is that, domestic growth is still fairly sluggish if you look at the rest of the world. And at the same time, quite reliant on Chinese demand in some areas. There's a lot of talk of Germany right now. So right now, it's not an area that we've been favouring.
How do you play China?
Well, China, again, is an area where people have got very, very pessimistic on China. And, you know, ultimately we think that growth is likely to remain sluggish there. But arguably that is starting to get reflected in market valuations. So generally, having been a bit underweight China, we've been moving back to neutral. From a top-down allocation, though, we need to be very careful about China. It's a very idiosyncratic market, really for active stock pickers only.
Johanna, thank you so much. A great pleasure to have you here on the Pulse. Johanna Kyrklund, their Chief Investment Officer and Head of Multi-Asset Investing at Schroders. Coming up, a show of unity for Ukraine. European leaders gather for a summit today as the future of U.S. aid for the war hangs in the balance. We're live in Granada with the latest. That's next, and this is Bloomberg.
They can buy or rent apartments at crazy prices, and this is pushing up the cost of housing. Second, sometimes these billionaires do not live, the idea of community, so they are happy. They live in a very vibrant city and an easy city because it is not so big. But we would like to have a sort of give back from them. On the opposite, we have the university students who have difficulties to find affordable apartments.
Well, that was the mayor of Milan, Giuseppe Sala, speaking to Bloomberg. Now, Ukraine's President Volodymyr Zelensky has arrived in Granada, where European leaders are gathering for a meeting expected to show unity in support of Kyiv. Meanwhile, U.S. President Joe Biden has announced he'll give a major speech about the importance of long-term backing for Ukraine. Well, Bloomberg's European correspondent Maria Tadeo is following the summit. Maria, great to have you on the program today. So Zelensky has arrived there. What's he looking for?
Yes, Francine, and he is here because it wasn't always clear. Remember, at the start of the week, it was suggested that Zelensky would not attend the summit, and instead it would be the Ukrainian prime minister who would sit in for him. Today, manifestly, he's changed his mind and decided to participate in the summit. And Francine, you can see the logic for the Ukrainians. This has been a difficult week for Ukraine. We know, obviously, the United States decided to opt out of an assistance package in the shutdown deal. We also know, and this may seem trivial, but it really has made the rounds behind the scenes. There was that tweet, that X-post by Elon Musk, which presented a man who was sweating, asking for cash. He was supposed to be President Zelensky. That has created a lot of fury internally in Ukraine. So by being here, there's two things that, of course, President Zelensky wants. One is that picture, that photograph of leaders. There are more than 50, almost 50 countries gathered here to show that he is not alone, that Ukraine is not alone. But there's also the political significance of this. He's going to have a number of bilateral meetings with a number of leaders. The Commission, Emmanuel Macron, the UK Prime Minister, is also expected to attend the summit. A lot of that has to do with further assistance to Ukraine, but also politically. Let's remember that Ukraine aspires to join the European Union, and the Commission is expected to put out an opinion as to whether or not the country is ready for open talks. That's another issue that he wants to talk about, but fundamentally, it is also about the visuals. He wants to show that here he is united by the international community, and he's not alone, despite the many difficulties he's had this week.
So, Maria, how much fear is there that U.S. support is actually waning or going to wane even more into the election year?
Yes, and Francine, that is really the tension point. And we know it has been privately, maybe not so much publicly, but it has been privately among European leaders, because so far the Biden doctrine is very easy to read for them. It's yes to the weapons and yes to money to Ukraine, stand with Ukraine, and it is unconditional. But obviously now they see, and they see it very clearly after the shutdown deal, to leave that aid aside, that this is an election year, that it is volatile, and that that kind of aid may become difficult. What I would say, say, however, is that this morning there is a lot of curiosity about that announcement that President Biden made yesterday. He said, quote, he's going to make a major speech about the need to keep the long-term funding for Ukraine. But there's one particular line that really has gathered a lot of attention here, which is President Biden saying even if Congress does not approve of further aid, there are other ways the United States could continue to keep that, although he did not specify. That is one issue where the European Union would like to see clarity, because then that takes us to the fundamental question. If some of that support is decreased by the United Nations, or excuse me, the United States, will the European Union make up for the shortfall?
Maria, thanks so much. Maria Tadeo, their European correspondent, of course, on the ground for us, following all of the latest developments. Now, in corporate news, Barclays is also dismissing roughly 50 senior deal makers as part of its annual staff cut. The layoffs are said to be part of a plan to trim headcount by about 300 people across the corporate and investment bank divisions. Now, that amount is about 3% of total headcount in the unit, which also includes Barclays' trading operations. Coming up, Rishi Sunak tries to rebrand his administration and effectively fires the starting gun on a new electoral campaign. We'll unpick all of the key details in our special UK show. That's next, and this is Bloomberg.